We want long-term capital gains instead of short-term capital gains, right? So
It's
all about taxes. I mean, if you can wait just a few months and save quite a bit on taxes, then that's what we're going to do, and that's what our plan is, and that's what we will do.
So Brian, what's up, man?
Hey, not much. How's your weekend?
It was really good. It was really good. So I'm excited we're doing a live. Let me get this shared really quick. I don't know how to do that.
We got to figure this live thing out.
Yeah, we're testing it out. But generally speaking, we're going to talk about our latest, the latest investment opportunity.
Yeah.
Right. So we did that last Kiddie Academy. Go through that a little bit. I'm going to get this shared.
Okay. We've actually got a couple that are going on right now. Our first one we started first of 2020. It's a Kiddie Academy in Columbine, south of Denver.
Yeah.
Kiddie Academy is early childhood education, sort of childcare education. So their philosophy is that they do childcare. They're anywhere from infants to 12 years old, but their philosophy is that that they're going to have some education, some health and fitness, and just pretty rounded curriculum rather than just normal childcare.
Yeah, and I think it's a good setup because we timed it really well. We were kind of looking at that early childhood education space because it's a good asset class to have because it's pretty stable, right? Yeah. Children are always going to be around. They're always going to need education. They're typically going to need a kind of semi-quasi babysitter while parents are at school or at work or whatever.
Yeah, it's always going to be needed no matter what. Well, and we saw that during the 2020, right? During the pandemic, these places thrived because people still needed to work. They spent the first part of their paychecks on their kids, right? Mm-hmm. They want their kids, no matter what happens to them, they want their kids to do well and not to suffer.
Yeah, and I mean, if schools are shutting down, I mean, they're going to be needed even worse. And what we found is a lot of these early childhood education facilities, like the Goddard School or Kiddie Academy or Primrose Academy or just stuff along those lines, a lot of them stayed open and were full throughout COVID or last year and are full now.
Yeah, people had to move into them, right? Not away from them. Their kids weren't in school. They needed them in school. The parents had to work as much as they could. I think more people have decided maybe to transfer to these kind of places full time. I think some of the parents kind of lost faith in the public school system during a pandemic, right? Yeah. Sometimes they were in school, sometimes they were out of school. Their online curriculum didn't work very well, and they just got tired of it. And they said, "Hey, we're going to go someplace where they've got it together. Kids can be in class and learning." So.
Yeah, I mean, I don't want to get into this too much, right? But like, I send my kids to a smaller school just because of that reason. It's a smaller school, like a Kiddie Academy. It's privately owned. There's less people, less contact, and they've been shut down through COVID one time. So we've been, extremely fortunate.
Yeah.
But anyway, this is about the latest investment. So what we do is we go in and we partner with a group down in Dallas, Fort Worth. Company's called the Woodmont Company. Definitely couldn't do it without them. Those guys are amazing. Yeah. But we go in and we basically have a signed 15-year lease before we even fund the deal, before we even offer it to our investors. So there's some security there just in the fact that 15 years is a really long time. So somebody's fully committed to that building for 15 years. They've got annual lease increases already built in.
Obviously, these people have been highly vetted to make sure that they're responsible and know what they're doing, right? They've got the funds and everything else.
Yeah, it's funny. There's typically one. It's typically a husband and wife or a couple combo, and there's typically one of them that's deeply rooted in education, and then the other one is typically more, entrepreneurial minded, mm-hmm. And they want to go own a business, and then they couple up and can really dominate it. Yeah. But yeah, you're getting financial statements and balance sheets and resumes and everything, and we, the Woodmont Company, our partners down in Fort Worth, they have weekly calls with the tenant once we get up and running and start construction, just to make sure, we don't miss a beat in communication, because when you're building a new building like this, timing isn't an exact science, right?
Right.
But generally speaking, we're going to go in, we get this lease signed for 15 years, and then we just go build the building. So a lot of it, you want to build it for as cheap as possible, but quality. So a lot of it is just architectural documents, getting bids out, getting competitive pricing, making sure land is for a good price. So our partners in Fort Worth do a lot of the site identification for Kiddie Academy.
Right.
They're a preferred developer for them. So Kiddie Academy says, hey, we want to be in these markets, or we have these franchisees that want to open up locations, and Woodmont really goes in and finds the perfect spot.
Yeah.
Which is good because they're great land brokerage guys. I mean, they can find a good piece of land.
And it could be anywhere in the U.S., right? I mean, Woodmont works all over the U.S. Kiddie Academy has, 259 locations all across the U.S. I mean, it's from West Coast to East Coast and north to the south. So it could be anywhere.
Yeah, and I think they're in, 30 states or something.
Yeah.
But, pros and cons, and feel free to just, ask a question if one comes up. But pros and cons is they're shorter deals. So a lot of our other deals can be 5, 7, 10-year deals just waiting for the asset to appreciate enough to recapitalize through some sort of sale or refinance later on down the road. Whereas this one, the business plan, the profit to be made is strictly on your delta between the cost it takes you to develop it versus what the income is worth after the tenant is in there and the building is done. So you're selling less on the value of the inherent real estate and obviously on the income, right? Because we're going to sell this to somebody who wants the stream of income that this building will produce after the tenant is in there.
Right.
And they can go in and say, hey, there's a 15-year lease on this. It's in a great area of town. The one we did in Columbine, that's infill. I mean, there's no lots in Columbine. You can just go pick up. It's really hard to find good location. Yeah. This last one we did is in,
same thing. Yeah.
North Dallas. Right
in between, what is it, close to north of Addison, I think, between Plano and Richardson, I think. So it's a really good location in North Dallas.
Yeah, I mean, anybody who knows anything about North Dallas knows that they literally can't build houses fast enough. I mean, Texas is absorbing, most of the jobs leaving California, it seems like. And, I've got some family down in Frisco. And every time I go down there, it's nuts because of how massive it is. So
they're having to build a high school close to where we're putting this Kiddie Academy. There's so many families moving in, right?
Yeah. Which is a good thing because before they go to that high school, they're going to go to our Kiddie Academy.
Right. Perfect.
Right next door to a Kroger as well, which is a really big thing. We're almost in the same shopping center. And we're even picking up some extra land on that deal to sell. So that'll be a nice piece, but not really that important.
Right. So essentially what happens? So we partner up with Woodmont, and then it's time to, you talked about the lease. They found the land, and we're ready to go out to our investors. And so what's kind of the timing from there?
Yeah, so we funded a deal, this time last year. It was the beginning of January, end of December, and we're actually flying up to Denver here in a couple days to go check that out because it's done.
Yeah.
So a year ago, it was a check we wrote, and now it's a gorgeous building.
Yep.
Super excited about that. But yeah, we get the site, we vet it. We should be permitted on the new one in Dallas in the next 30 days or so. So I would say when you can tee up your loan closing, your land closing, and your permitting all in one day, you want to get funding about a month before that. Mm-hmm. And we've hit, I think 3 out of the 4 of those mile markers. We're waiting on final permitting, but we'll be funding that deal next week.
Yeah.
And they're nice deals. Both of these deals sent out to our investor list, and we're full within a week.
Yeah. Yeah.
We didn't double check with investors on either of these deals.
Yeah.
Normally you go through the rounds. Hey, are you interested? Hey, did you see this deal? Hey, can we take you out to lunch?
Yeah.
Go through the ringer. But our guys love these deals.
Yeah. Yeah. I think, like you said at the beginning, it's because it's a little bit different. You get your money back faster. You get a nice little multiplier on your investment, and then you can do it again on a similar, maybe a Kiddie Academy with us again, or we've got some other deals that are more traditional that we've done in the past where you're doing it for the cash on cash, and then maybe gets sold, like you said, in 5 to 10 years. Right.
But one of the big questions I get is what's the risk? What's the downside of this building? Right. What's the biggest risk of the investment?
Yeah, it's a good question.
But there's markets for these things. So when you're going and buying, stocks or whatever investments, you want to gain, research and analytics, and you want to go, vet, that it will sell for that amount or somebody else will buy it for that amount. You know, you kind of want to verify it third party. You want to make sure this house goes for market. You want to make sure you can sell that car for market. So there's a market for these sorts of buildings. And I mean, over the past year, we've been watching it closely, obviously, because we're, you know, pretty highly invested now. Yeah. Mm-hmm. But there's a lot of sales of Kiddie Academies and Primrose schools and Goddard schools. And they're becoming a lot more attractive investment class just because, you know, some of the other ones aren't doing as well in 2020 and in COVID and this new e-commerce environment. Right. But school is really, you know, the root of a service-based tenant. Yeah. Because the parents have to go to work typically. Right. And these kids have to go somewhere. And we've just found that these schools fill up so fast. I
think a lot of people might be afraid that, hey, all these other schools because of COVID went to online learning, but I think you talk to 9 out of 10 parents, or maybe it's 99 out of 100. They didn't like it. They didn't like it. They wanted their kids to be in class for a variety of reasons. But so I don't think there's any chance of schools going to, you know, mostly online learning.
Yeah. And the downside is we finish the building, the tenant gets in there. We've got a 15-year lease with that tenant. That's going to be cash flowing. So, I mean, worst case scenario, we can't sell it, which we can. We would hold on to it and keep the cash flow ourselves. Yeah. I would say the only other risk in that is the risk that the building doesn't get finished, but there's insurances and the partnership team that we've put together and the lender and just everybody striving to that same beat. Right. It's hard to mess up that bad on this deal. It's hard to miss it by that much. Yeah. And especially when you're looking at North Dallas infill of, you know, where it's at, you can look and see where the houses are at, where the people work, you know, the traffic counts on the road, the amount of money they're making, the schools around. I mean, you can look at the data and the deals are great. Yeah.
Another risk people might think is, so what if what if the franchisee isn't performing? Does Kiddie Academy have some, do they have some ramification that they can go in and take it over or get rid of that franchisee and bring in another one? What's the risk there?
Yeah, so first of all, Kiddie Academy's close rate is less than 1%. I think they've had like 2 or 3, and they were all extraordinary circumstances. It wasn't because, you know, the market couldn't support or something like that.
That's really low.
It's really low. Yeah. That and Kiddie Academy is a franchisee. They do have a right in the lease to step in if they're not operating it right, if they're not hitting benchmarks, if they think it should be done better. And we've obviously got a relationship with the tenant. But more importantly, we've got a relationship with the franchisee and Woodmont, especially. You know, they've worked with them for 15, 20 years now, a really long time. Right. So, I mean, they used to just broker for Kiddie Academy, and then the trust just kept building up, and it was like, hey, guys, we need you in our corner. We need you to vet sites. We need you to build these for us. We need to make sure we're in the best spots. And how many
of these is Woodmont doing a year? How many Kiddie Academies are they developing a year?
Just Woodmont, they're doing about 15 a year. Yeah. Which is a lot.
Yeah, that's a lot.
That's a lot. So I know they're striving for 15 a year, and, you know, 2020 they probably got delayed a little bit. Probably, yeah. But I mean, just the sites they've teed up to us that they haven't, you know, announced yet, and, you know, we passed on 1 or 2 already. Right. We could be doing more. Yeah, we could. We just want to make sure all these risks that we're talking about and all this data that we have really comes to fruition, and it really has. Yeah, like you said, we're flying up there day after tomorrow. We're going to do the walkthrough. Hopefully, soon after, the certificate of occupancy gets issued and the tenant takes over. And then one thing we haven't discussed is after that, I mean, you could take us through the timeline of how long does it take to build? Yeah, let's do that. And then when do we look to start selling? Yeah, so we'll have to get some like pictures of the dirt lot that was before and the building now. We'll take some pictures and maybe put it in post when we upload this.
That's a good idea.
Or later. We won't be able to do it in post Tuesday because we fly to Denver Wednesday. Yeah. Anyway, we'll upload it. We'll show you guys, I promise. But anyway, yeah, it starts out with a piece of dirt and there's a live construction camera on it. And the biggest thing is you want to be fully permitted. You want to have a loan fully approved. And you want to have your equity funded, you know, all around the same time, because it's all about timing, right? Once you're permitted, it's a pretty smooth train, right? So you want to get the equity in as close to permitting as possible so you don't just have dead equity sitting while you can't do anything with it. And permitting is a decent risk or entitlements, it is. Whatever you call. So you want to make sure that you're good or like 99% good on the permitting before you go in.
Right.
So that's going to happen. Then you're going to get the permits, and basically that just says, hey, the city or the county or whatever municipality says, hey, you have the right to build that building. We'll inspect along the way, yada, yada, yada. Yep. It's about a six to 9 month build time, just depending on the weather.
Right.
They could knock it out in 6 months if it was sunny and gorgeous every day, but it never is.
Well, in Dallas will be a lot better weather than we had in Denver. And it wasn't that bad, but I mean, there's not that many snow days or, such cold days that you can't do certain things.
Yeah.
Dallas,
Denver, some of these last things like installing turf and asphalt, it's got to be 40 degrees.
Yeah.
Dallas, by the time we're breaking ground in mid-February, most of the weather should be gone.
Well, it'll be gone, and then we'll be done before
it comes in.
Yeah, before it comes in that following fall. So that's good timing.
Yeah. So construction is 6 to 9 months, and then we'll get the certificate of occupancy, which that municipality that gave you the permit comes in and says, hey, this is fit to be occupied. You built it to the city standards. You did what you said you were going to do. Everything works. It's good. They do the same thing on a house when you build a new house, if you're familiar with that. Mm-hmm. You get the certificate of occupancy, and then we decide to hold it for 12 months. And why do we do that? That's the question, the biggest, why don't we sell it immediately? The tenant's in there. Why do we not sell it immediately?
Yeah. Well, we want long-term capital gains instead of short-term capital gains, right? So it's all about taxes. I mean, if you can wait just a few months and save quite a bit on taxes, then that's what we're going to do, and that's what our plan is, and that's what we will do.
You also get that year of depreciation as well.
Yeah.
So you're depreciating it along the way.
Right.
It's paying down the capital balance. It's cash flowing that year that we hold it, and then we're allowed to sell it 12 months after we get the CO. So. What was I going to say? We'll tee up the sale or the brokerage or, get it on the market, so to speak, around month 6 to 9, because you're going to have a marketing period. You're going to have a sale period. You might, lose somebody for whatever reason. Maybe they drop it or, whatever. Things don't go perfect.
Yeah. We'd love to sell it just as soon as that 12 months is up. So we got to get started before that.
Absolutely. Yeah. Absolutely. And then, the returns, on the two we've modeled so far, you're looking at like a 1.4 equity multiple from the time you put it in to the time you put it out. If you put in 10,000, you should get out 14.
Yeah. And that's going to be about 18 to 24 months. Is that right? Yeah.
Yeah.
So what's your IRR? What's that work out to on an IRR?
So the IRR is time-based. So 18 to 24 months, there's a variable there.
Right.
But we're targeting 20 to 25%.
Okay.
And those...
Depends on how quickly you sell it.
How quickly you sell it.
And for what you sell it for.
And then for what you sell it for. And again, it's the cap rate. So, you could sell for, 6.5, 6.75 cap rate. You could sell for higher. We go in and split the middle and assume a 7 cap sale. Mm-hmm. The comps we have, all of them are lower.
Yeah.
We just do a 7 cap because it's modest and it gets us the return our investors were happy with. And if they're happy with 20% and it's believable and it's modest, there's no reason to pitch them 26 when you could hit it.
Yeah,
I'd rather pitch them 20 because 20 is arguably, it's got to be risky. Oh, that's too high. What are you doing that's something different? You're making 20% of your money. That's a lot.
Yeah.
So you're advertising higher than that. People just won't trust you at face value because they know you're assuming the moon.
Yeah. Yeah. We don't want to do that. And if you look on the Woodmont website or you look into the Kiddie Academies that they've done, that they've closed on now and sold.
Yeah.
Their projected returns were always less than the actual returns. They always increased the returns, I think, on nearly every single one of them. There might have been one where it didn't, or maybe it slightly dropped. So what if they projected 22 and it went down to, I think the one I'm talking about might have gone, it was still in the 20s, I think, or maybe 18. I mean, that's still a really good return. But a lot of them are netted an IRR in the upper 20s. So that's really good.
Yeah, you want to focus on the IRR. You also want to focus on the equity multiple with short-term deals like this, just because with 18 to 24 months, it's if you're comfortable with the equity multiple, then 18 to 24 months is kind of irrelevant almost.
Yeah, right.
The next thing I think we should hit real quick is just how the investors are doing now. So we oversubscribed this deal about a week ago, and then now the investors are just going through the process of getting their accreditation status verified. So we had a letter typed up. They've got to get signed by their CPA or attorney for this type of deal, just because we're advertising it. We're on Facebook Live. We're screaming it from the top of a mountain, so to speak. So
everybody had to be accredited for this particular investment.
Exactly. So they're going through those steps, and then they hit a button on our website. They said, "Hey, I want to invest now," or they shot us a text or an email. But they were in that exclusive investor list, so they got the email, they got the invite, and then we just started getting peppered with emails. Hey, I want in. Hey, I'm interested. Hey, I'd love to go to lunch, asking more questions or whatever. At the end of the week, it was full, and now this week we're sending them documents. So the majority of them are going to be in a DocuSign format where we've gone in and pre-formatted everything. It'll auto-populate certain fields based on your profile.
So easy. It's so easy.
It's really easy.
You click a button that says, I want to invest, and you tell us how much you want to invest. And then a week later, I think, you got all the forms uploaded. And so you just go in there and click on each form that needs to be signed. And like you said, it's DocuSign. You don't have to print anything off. You just sign it, and it sends it back to us. And you and I have to countersign some of it. And I mean, literally, you could do all that literally in 15 minutes, I think. Don't you? I mean, maybe it takes a little longer to read everything, but I really think you could do it in 30 minutes or so.
Yeah, it's funny. There's guys who are really good at paperwork, and there's guys who are really not good at paperwork.
Yeah,
it's funny. The real estate guys we have, the sophisticated real estate guys who own some real estate without us, who are in the game of real estate investing, almost as much as us. Those guys are the best with their paperwork because they understand what it feels like to have an investor who's not good with their paperwork. There's some guys, I mean, you send them an email, hey, sign this, and it's, I mean, lickety split. And there's some guys, it's like, hey, bro, I really need that form. I know you gave me money, but
I need that form.
I need that form.
And I'm going to print it out, and I'm going to sign it, and I'm going to scan it, and I'm going to send it to you, or I'm going to mail it to you, or I'll drop it off to you.
We'll send a horse, bro. Okay. I need that form.
Yeah, whatever it takes, we're willing to help out.
But generally speaking, it's super easy. We get a lot of feedback that, I mean, it's a few buttons. You can do it from a smartphone, tablet, computer. I mean, trying to be easy.
Yeah.
Well, what else, man?
I don't know. I guess we'll have an update for everybody after we get back from Denver.
Yeah, we'll go to Denver Wednesday. Like I said, we funded that deal about a year ago, and it's finished now. The tenant should be taking occupancy by the end of the month, finishing touches, doing the punch list. Super excited about that. And that's
when that 12-month period starts, right? The certificate of occupancy.
Absolutely.
Yeah.
Absolutely. So this time next year, we'll be selling that deal in Denver.
Yeah. Mm-hmm.
Which is awesome.
Yeah.
Which is awesome.
I can't believe a year's already gone by.
I just love the fact that we can fund a deal before COVID, have 2020 happen, have everything that's happened happen, and we're still
on target.
We're still on target.
Yeah.
That's amazing.
Yeah.
That's amazing.
We were on time and on budget on that thing. So, yeah, during COVID, that's an absolute home run.
Which
really
is why we're giving them another $1 million, right?
Yeah.
All right, guys. Well, be sure to check us out on howtoinvestinCRE.com. If you haven't if you haven't gotten your free LOI from our website, it's invest.howtoinvestinCRE.com. You'll get your free letter of intent. We'll teach you how to use it. Make sure you're on our investor list. Like I said, I mean, we sent an email out, and within the week it was full, and we didn't really double check with anyone. We didn't have to beg. We didn't have to ask. It's like if you're on the list and you're not paying attention to the emails, you're missing out. We had some people who just, were asking a lot of questions and didn't necessarily reserve a spot. They were kind of out.
Yeah.
So pay attention, and I would just encourage you. There's a lot of people we talk to, and they're just like, "Where do we get started?" Well, you got to build up some trust with me and Brian. You got to build up some trust in what we're doing. Go watch our podcast. Go watch our show. Listen to our offerings. Pay attention to our emails.
Sign up for our investor list, and listen to our podcasts and give us a call. We've gone to lunch and dinners and coffees with lots of investors who want to ask personal questions and get some good answers. So just any of that, and it's really easy to get educated if you do all those things.
Yep. All righty, man. Well, I think we're good, and we will catch you next time on How to Invest in Commercial Real Estate.
Yeah.
Later.
Thanks.